Welcome from me, Guy Monson, to our first 6-minute strategy of 2025. Investors will remember last year as the year of the market correction that simply never arrived, despite geopolitical turmoil in Ukraine and the Middle East and escalating trade tensions with China. Most every major equity market delivered positive returns. Even Mr. Trump's clean sweep in Washington, which most saw as a potential source of uncertainty, was interpreted by markets as an opportunity for deregulation and innovation. With this in mind, we've maintained an overweight position in equities throughout 2024. We held our positions in gold and as of last quarter moved to further underweight bonds as credit spreads narrowed to historic lows. Against this positive equity market backdrop, 3 key events are on my worry list for 2025. First, sticky core inflation means central banks are stalling their rate-cutting programs. Second, we see continued pressure on sterling and UK gilts as investors fret about fiscal sustainability. Third, we're worried that China is slipping into outright deflation, with worrying implications for global trade. We'll look at these issues more closely in the slides ahead. Well, let's begin by looking at the performance of global markets back from 2024 to date. And you can see in that left-hand panel, that dark blue line, global equities, an extraordinary rally right into the close of 2024 and on to 2025. Look at the difference between the main index and its equivalent equally weighted. That's you put an equal weighting on those large tech supercap AI winners. That divergence of nearly 14% is the largest that I've seen in my 40 years in the industry. And what are the minute winning styles? Well, as a result of that, momentum was the best thing you could have done. Buy what went up yesterday. This again was that extraordinary momentum in the AI growth stocks. Growth outperformed value, and look at that green line at the bottom, poor dividend yield, sharply underperforming as bond yields rose, but offering some real opportunities and value, I think, for 2025. Let's reflect on the other assets. Well, in the aftermath of Trump's extraordinary clean sweep in Washington, of course, the dollar rallied strongly, up 8% for the year, the strongest G10 currency. Despite all the conflicts in Ukraine and the Middle East, oil was flat for the year. Gold, a great performer, a core of our portfolio, is up 28%, on worries again about fiscal sustainability. Well, those same worries impacted global bond markets, and that was a real negative part of last quarter. You can see US T-bond yields soaring up there almost to 470, and that very aggressive backup of UK gilts as the market really begins to worry about the fiscal sustainability of Chancellor Reeves' programme. So against this broadly supportive backdrop for equities, what are our worries for 2025? Well, number one on my list is that stubborn, sticky core inflation rate around the world at somewhere around 3%. Central banks, as a result, are getting much less generous or hawkish, and markets now anticipate 3 fewer cuts out to 2025 in the US, and here in the UK actually 4 fewer cuts. So much tighter monetary policy, I think, than we expected. Risk number 2 is principally in the UK, and yes, it's about this budgetary sustainability and the flexibility which is rapidly slipping away from Chancellor Reeves' buffers. You can see the impact really ever since the Labour election. Economic surprising index, that's how economic numbers came in relative to analyst expectations, has really fallen and fell again at after the UK budget. It's also affecting business optimism and surveys, and you can see there that blue line, UK business optimism, falling sharply, almost to the levels it was at the worst point of Liz Truss's budget. By comparison, the US business confidence, that red line, has soared over the last few months in the aftermath of Trump's victory, as people believe that he really will support deregulation and innovation. So a worry there on UK fiscal sustainability, and I think we're going to need some budget cuts to restore credibility. My final worry is, of course, China, where we've highlighted all year these growing deflationary forces. Now, the Chinese CPI came out this week, it was up just 0.1%. That's driving bond yields on China ever lower, and at just 187 they've crossed with Japan, and that risk of Japanification beginning to emerge. And what it means, of course, is it's very difficult to make a profit, and particularly in these aggressive export markets where Chinese companies are so underpriced. Now, we always knew that state-owned enterprises didn't make profits. That's the red line. 26% of them unprofitable. But look at that climb in the unprofitability of the private sector. So a real squeeze on Chinese equities. Hence our very, very minimal exposure to all Chinese equity assets. So let's wrap up on our policy and look forward to the remainder of the year. We're starting with a position underweight bonds. We're worried there about fiscal sustainability. We're remaining overweight equities. We're still a core holding in global AI, but attracted to some of the opportunities in the more value sectors of the market. In alternatives, our big position is to overweight gold, and we're funding this with an underweight cash position. And my key risk, the bond markets, global trade, and of course a major AI tech profit warning. Well, I hope that's helpful. I hope it sets the scene for 2025 and shows you the opportunities and the challenges which you need to emphasize in your portfolios. Well, thank you.